Hello and welcome. You're watching News Now, and IIP numbers are out on your screen. 1.5% if you compare YOY, that is 4.9% which was there last year. But to discuss IIP numbers, what does it mean? I have with me two important guests, Kanika Pasricha as well as Sakshi Gupta. Sakshi and Kanika, welcome to ET Now. My first question to you, Kanika, will be 1.5%. How do you read this number?
So actually, Ankur, first of all, thanks for having me on the show. The number is lower than our estimate, which is 2.2%. We thought there'll be at least some slightly better recovery from 1.2% last month to around 2.2% this time round. But it seems IIP is just edged up from 1.2 to 1.5%. It primarily appears that the source of the downward surprise is mainly manufacturing growth, which we thought will be able to exceed the 4% mark in this month. But it seems it's got settled at 3.9% if I look at the data flashing on your screen. Apart from that, there is downward surprise because of earlier start to the monsoon this time. So rain gods have blessed us, but that's putting downward pressure on the likes of mining and electricity sectors, which are both in contraction mode. So all in all, data lower than estimates. It's just flattish compared to last month.
Yes, data is definitely flattish if you even compare with the last month of 1.2%, and more details appearing on IIP data. Mining sector growth is actually negative 8.7%. Manufacturing sector growth is 3.9% if you compare YOY. Last time it was 3.5%. Similarly, electricity sector growth at minus 2.6% compared to 8.6% YOY. Sakshi, how do you assess these numbers, especially mining and electricity sector growth?
Yeah, thanks, Ankur, for having me on the show. Look, I think like most indicators that are coming out in the economy, I think the IIP numbers are also showing you very, very mixed picture, right? I think the headline number, of course, is better than the print that we got for the month of May. But if you look at the quarterly average this year, compared to last year, IIP growth has, I think, averaged close to 1.7, 1.8 compared to 5.5% average growth last year. So that is one. Of course, we know that this is happening. The weakness or the moderation in IIP growth that we are seeing is being driven, as you pointed out just now, is being driven by the low, electricity and mining number. And as Kanika mentioned, a lot of this, of course, has to do with some of the seasonal impact and the rainfall pattern, and the early onset of monsoon that we saw this year. Beyond that, I also want to talk about some of the positive from the IIP data. Look, on the manufacturing side, of course, growth has inched up from where it was in the month of May. If you look at the 8 core sector data, the growth that we've seen this time in June in sectors like steel and cement, again, have been very, very good, right? So I think there are mixed stories at present, if I look at cumulative sense of the IIP numbers, but of course, at the headline level, I think things are seeming much more moderate than where we were last year.
All right, more granular details coming in for IIP numbers. Those viewers who have just joined, let me recap once again. IIP growth is at 1.5% versus 4.9%, while mining sector growth is minus 8.7%, electricity sector minus 2.6%, and primary goods output at 3% this time compared to 6.3% YOY. And also, if you look at the positive side, capital goods at 3.5%, intermediate goods output growth at 5.5% this time, and infra goods output at 7.2% time. So mixed kind of bag coming in for IIP number, but yes, the headline number is 1.5%. Kanika, what is your take on infrastructure goods output, which is at 7.2%?
I'll refer to Ankur what even Sakshi talked about. See, government capex spend has persisted. In fact, even steel, cement growth within that core sector growth of around 1.5, 1.7, steel and cement sector are clocking more than 9% growth. and that's reflecting in the outperformance in infrastructure slash construction segment. We all know currently private capex recovery is lagging. There is global uncertainty. So thanks to government spending in infrastructure sector, in the overall capex this time they've been more consistent compared to same period last year when due to elections there was a lag in capex spend, which is why infra slash construction sector is outperforming it. It's the same thing in GDP as well.
Right. This is as far as infra spending is concerned, but overall, if you see the capital goods output is also at 3.5%. Your take, Sakshi, on that?
I think that is a decent number. Honestly, there are also, a lot of lumpiness and base effects in the IIP data, right? So you kind of have to average everything out and look at momentum, right? So clearly the capital goods bit and the infrastructure, indexes have relatively been outperforming the overall IIP index, right? Which to me, so I wouldn't just look at 1 month's number, but I think the general idea or the general indication that we are getting that is corroborated by the government spending data that is, that we have up till May, does show there has been a front loading of capital expenditure this year by the government. And I think there is, based on that, there is some amount of momentum that we are seeing in this part of the economy.
Right. Kanika, as you mentioned, this data is below the expectations. I want to understand which are the areas where it has exceeded the expectation and which are the areas where it could have done better.
So I would say, as I stated, on a sectoral basis, where it has exceeded expectations, where I would say it's been lower than expectations, at least our expectation, because our estimate was 2.2, number came in at 1.5. So our, for instance, manufacturing, we had thought will exceed the 4% mark. It's risen, but still falling short at 3.9. Mining, we had thought will be around -6.5. It's at -8.7. So there also it's fallen short. On the use-based side, Ankur, what's happened is that while on infrastructure and construction, the numbers are aligned, we've actually been surprised more by the capital goods number, because last 2 months it was clocking 14%. This month it's clocked only 3.5. I would agree with Sakshi. There is base effect. Maybe, the government capex pull up. We don't have the June government capex data till now. The fiscal numbers will be out on 31st. So maybe the pace of spending slowed down in June compared to high double-digit growth clocked in April and May. So which is somewhat weighing on capital goods IIP this time.
Right. If I ask you, Sakshi, the same questions, now, which are the areas which has completely been below the expectations?
Right. Just before that, I think I still don't have the number on consumer durables and non-durables. I think
durables, let me add the consumer durables number here. Consumer durables output growth is at 2.9% versus 8.8% YOY. Of course, so this month it has come in at 2.9%, and consumer non-durables output growth is at -0.4%. So what is your take?
Right. Okay. So I think my IIP number overall for this month was 1.7. I think, this number has come in slightly below my expectation. I think the major disappointment, so to say, or deviation from my forecast, I think stems primarily from the mining, number, because at -8.7, that is actually much lower than what we were accounting for. Unlike some of the other data that we track on consumption side, I think from the IIP perspective, I think things have been very, very volatile, and we're still not getting very definitive signals on the rural or the urban consumption side, and how that is filtering into the production indicators on the IIP bit. So I think that is one bit that is not aligning broadly with other indicators that we track. For instance, on the rural side, there are a lot of indicators like two-wheeler sales or tractor sales that seem to be picking up momentum and doing better.
Right, Kanika, as far as now policy is concerned, now this kind of weaker than anticipated data, do you think there will be an impact on the MPC meet?
So you know what, Ankur, we feel that there are two, 3 points. First, IIP itself, the vintage series, it's a vintage series, and its impact on manufacturing GDP or manufacturing GDA growth is relatively limited. A more important role is being played by corporate earnings, which are likely to be better in this quarter. Even though the top line remains weak, which is the sales growth numbers, just because the costs have come down due to lower commodity prices, we see net profit numbers rising. All in all, for April to June, as per our calculations, overall GDP growth numbers are tracking around 6.7 to 7% range, while MPC's estimate is 6.5. That's one. Second, even though we see the MPC downgrading their inflation forecast by anywhere between 90 to 150 basis points for Q2 and Q3 for September and December quarter, we still believe it's an upward trajectory for inflation from here on. And after giving a steroid dose in the June policy, with one part of that dose in the form of CRR cuts impending in September, uh, as of now, better to wait and watch, maintain status quo, though we do not deny that there is possibility of some space opening up, maybe in the second half of the year, if inflation remains well behaved on favorable monsoon. Thanks.
Right. Sakshi, I want your take on this as well. Now, with last time front loading was clear cut indicated that we have done 50 basis point. Now, do not at least expect anything. Now, having said that, inflation is of course in favorable range. IIP data of this kind, how do you think this will prepare the turf for Reserve Bank of India?
Right. I think the bottom line first. Let me talk about the bottom line of the policy. Right. I think that this particular IIP number, doesn't really materially change, the outlook or expectation for the upcoming MPC meeting. I would expect, I think, broadly in line with, the consensus that it is unlikely that the RBI is going to, deliver a rate cut in the upcoming August policy. I think that, there are a couple of things. One, we are also tracking GDP growth for Q1 close to 6.8% right now. The data on the economy, as I said, not just the IIP numbers, but a lot of the data has been very, very mixed, right? So things have kind of been holding up. I don't see, a major downside risk at this stage, to the RBI's GDP growth forecast for the year. At the same time, of course, we know that given the inflation prints, there is space now, for, further rate cuts because the inflation momentum has been coming down quite durably. Monsoon progress has been well, reservoir levels are holding up. So perhaps we are also moving into a, good Rabi season crop and therefore contained food inflation for some months. But having said that, I believe that the RBI would want to kind of, wait and watch, and see how growth momentum kind of progresses from here on before, kind of jumping in and delivering another rate cut. In my opinion, the possibility of further rate cuts from here on are actually limited because I do believe that, growth is kind of picking up momentum, both benefiting from the front loading of interest rate cuts as well as the tax cuts that were, announced at the beginning of the year, a lot of the front loading of government expenditure. So, yeah, I mean, I would not expect any change on the policy front, although I do think that the RBI is likely to downward, perhaps revise down its inflation forecast from 3.7%, given that, the recent numbers have been so low. So they've brought down the overall inflation trajectory for the year. But, just kind of at the same time highlight that, low inflation numbers mean that, next year inflation again is going to pick up because of base effects. So I think they'll kind of abstain from moving on the rate front this time.
All right, Sakshi Gupta and Kanika Pasricha, thank you so much for joining with your views on IIP data. And IIP has come on the 10-month low of 1.5%. But it will be interesting to see which are the cues which actually MPC takes from these data points. With this, it's time to take a very quick break.